Bitcoin bulls are in the pen. Are they going to work their way out of this, or are they headed to the slaughterhouse? Hey, guys, it's Keith Allen. And, well, as you can see, we've got some price action shaking things up here on the Bitcoin chart. So as we head into the weekend, let's take a look and analyze and see exactly what I mean. Obviously, not literal, but figuratively speaking, when I say that the bulls are in the pen, and I'm just going to show that awesome graphic one more time because, why not, right? What I mean is like they're kind of pinned, right? Let me show you what this means in terms of where it is on the chart and where we might go from here. So let's go ahead and share the screen and dive right into the action here. First, we'll take a look at liquidity in the order book on fire charts. And what I mean here is we have had this resistance overhead, and you can see that breakdown happening here. Man, it's been a busy morning. I really wish I could have got this out earlier because this was really what I was looking at here. And that breakdown is starting to happen as we speak. We might actually be moving into support. But the issue is that we have so much more liquidity up here on the upside than we do on the downside. And let's get things right here. What's going on here? Okay, that's better. So if we look above here, right, in this range of say like 63.5 up to 66, there's like a significant amount, and we can see it actually, bend a little bit better. It's easier to calculate here that, up in this range, we have, over 100 million in ask liquidity overhead up to 66K, suppressing price. And we don't have the same strength here to the downside in terms of bid-based support. And so, with over 100 million on the upside in terms of resistance and only about 70 million down here down to about 59.5K, obviously the bears are on the dominant side at the moment, right? These are short-term things though, right? Eventually this hopefully will change, right? And we're going to talk about what it's going to take to turn things around here for bulls, because the macro outlook still is unchanged in my opinion. But let's drill things in a little bit, and we can see what's happening here in terms of liquidity in the shorter term. And as you can see, that dump came from 63.5. A few days ago, we made it up to 65.5, which was solid, and a little bit of suppression here as blocks of asks came down and pushed price down. Now the question is, where are we going to bounce from? Is this prior range 58 to 60K? And I'm going to show you this in a second here, why this is an important range, 58 to 60K, not just the fact that there's liquidity here, but the history there. Or are we going to go even lower? Our local low at 56.5 right here. 55 has some decent support, about 17 million in support at 55K. And if we lose that, of course, then we're obviously going lower down to these levels. At least that's what I'm thinking. So let's take a look at what this looks like on the candle chart. And we had spoken quite a bit here this week about this 100-day moving average. And I want to note something here that I think is pretty important. Somebody commented, and man, I love the comments, by the way, so keep those coming by all means. Oh, it looks like we got one now, so let's see if there's anything here that we can. Jonathan asking, that's not a question, that's a statement. He says, looking for longs today, exclamation point. And this may be an opportunity to find one, right, as we get these dips. May go away, right? We say may go away is a pretty common phrase. Maybe May is find a dip to buy month. And that may be what we're seeing happening now. So back to what I was talking about on this 100-day moving average. And this is going to be a little educational segment for you. Yesterday, somebody commented about the difference in moving averages. I'm using a simple moving average. And the comment was that the EMA, the exponential moving average, had not been encroached. That's this one down here. I've actually added it to the chart. So let me let me remove it, and then I'll add it back in so you can see where things lay out. Okay, so on my chart, on the daily chart, um, the red is the 50-day moving average. The green is the 21. These are obviously crossed at this point. Blue is the 100, and purple down here is the 200. If we turn on the EMAs, you can see the difference in these. And the green 21s are very, very close to each other. And then we start seeing some spread between the higher time frames. Whichever one you use is really a matter of preference and relative to how you trade. Uh, I would say that longer term, the SMA uses a little bit different algorithm, and it is less responsive to short-term volatility, right? So for longer term trades, longer term charting, I think the SMA, or at least it serves me, and that's why I like it. For day trading, you might want the EMA because it is more responsive to that short-term volatility. But you can see a big difference here in terms of time frames. Personally, I've been using the SMA for so long that I'm really comfortable with it. But I'm willing to perhaps learn something out of this and start studying the difference on different time frames because again, with a shorter time frame, if you're day trading, then maybe you're not as concerned with these longer moving averages. I don't know. That's up to you and how you trade. But I would say that in terms of the way that I like to do things, I'm happy with what I'm seeing. If you want to learn more, really, it's worth taking a deep dive on your own. Google is your friend, ChatGPT is your friend, or whatever AI platform you like to use. You can learn a lot. So just wanted to put that footnote out there so that people understand the difference. You can see the 100 EMA is pretty close at this point. Looks like it's at about 60,300 ish, and the SMA that I've been dealing with is obviously a bit higher at 61,400. So and it has been obliterated once again. So now I'm gonna turn this one off. I'm gonna turn off the EMA so we can get back to doing what I normally do. If this continues downward, we may find a bounce here at 60K. This range right here, this red bar that you see, 58 to 60K. There's some historical significance to that, and I'm going to take this down. Actually, let me remove the trend precognition. I'm going to take this down all the way back in history where we had some prior consolidation at this level. So this is an area of historical importance, this 58 to 60K range. It's not just an arbitrary, block there. That's a range that has some history to it. And so that is a reasonable target. Now, in terms of where the liquidity is at this point, what's going to hold? Well, let's look at the liquidity can give us better clues sometimes than the technicals can. But my levels that I'm watching now, obviously, since we have again shot through those 100 days, my breakout or fake out zone and my critical support zone, I'm worried about this lower low. Somebody else commented yesterday, by the way, that they hate fat candles and wanted me to not have fat candles. Well, I use this to just show you, zoom in on these critical areas, especially for you guys, watching on phones so you can see it. But we obviously have a lower low here at 56.5. The lower range of this structure, which in my opinion, the structure, could be getting invalidated as we speak. And this other critical level here is the 21-week moving average, which I think is really, really the most important level on the chart. If the 21-week moving average is broken here, and that's currently at around, looks like 56, and this changes, right? These move every day. These adjust. If that's broken, then I don't have any confidence in this holding here on this structure. I would say that would likely be an invalidator on the structure if we haven't invalidated it already. And so that's what I'm looking at. And then where would we go from here? Well, 50 to 52K, reasonable target here. We did have a bit of consolidation, not nearly as much as we had down here in the 40 to 44 to 45K range. Actually, this whole range was 40 to 45, but the sweet spot, in my opinion, 44, 45K would be an amazing target. But at the moment, we just don't have any actual liquidity-based sentiment for those lower levels. So at the moment, we do have some decent liquidity in the 58 to 60K range. We'd like to see this strengthening, obviously, because as you can see, price is dumping into this. Let's move into the daily and see what's happening here, right? We've not seen a bounce yet here. So, in terms of when bulls are going to get out of this funk and we'll see that next move up, pinpointing that on the calendar is difficult. Pinpointing it via technical analysis is also difficult because these ranges can get over, TA can get obliterated from time to time, or invalidate your levels. It's not going to tell us, TA is not going to tell us what date Bitcoin is going to move, make a big move in either direction. But what will clue us into that is the liquidity. And at the moment, as we discussed at the top side of the analysis, we have more liquidity up here on the upside, concentrated than we do on the downside. So Bitcoin has to do one of two things. It needs to establish a local bottom, a solid bottom, and that's going to be confirmed by retesting those levels. So we need to establish and test a confirmed local bottom. We thought it was going to be 59K. It wasn't, right? Price broke through. So is that local bottom going to be 56.5, or is it going to be the 21 week moving average, or is it going to be down here in this 50 to 52K range, or potentially lower? At the moment, all the sentiment is above 50K. So no sentiment for this at the moment, but nothing changes sentiment, my friends, like price. So if we did see price move down to this level, chances are we're going to start to see more bid liquidity come into this range and above. So those are the things that I'm watching for on fire charts at the moment. Again, the real concentrations of liquidity are here and lower. Let's go to this 55K. 55K has still not a ton, right? This is the order book on Binance. It is the obviously the highest volume, largest exchange in the world. The volume on Binance exponentially exceeds all other exchanges. In fact, it exponentially exceeds what probably the top 5 or somewhere between the top 5 and 10 exchanges are doing in volume in terms of, big exchanges anyways. So that's what I'm looking at. I'm watching to see where this landing zone is. As you can see, the CVD, this is order flow. These are market orders, and the market is in a nosedive. Don't allow yourself to believe that this orange is necessarily all retail getting wrecked, because it's not. We have some evidence based on the volume that we've seen out of this order class that whales are using this order class to TWAP basically against the market to, in many cases, accumulate when price is going down and to distribute when price is going up. I have no issue with that strategy whatsoever. In fact, I think it's a good strategy. So, again, these are the levels that we're watching here. This somewhere in here should be the bottom, but we've yet to confirm it. And that's what we need to see. We need to either see a confirmation via retests that one of these levels are going to hold, or we need to see a confirmed and validated breakout, which has yet to happen at any level. And the one that I'm watching the most, the one that I think is the most important, is this 69K level. This is what we need to see. We need to see price printing full candle bodies above this level, and then we can talk about going after the all-time high and then getting into price discovery mode. Until that happens, until we either retest support and confirm it, or we get a confirmed breakout above this 69K level, in my opinion, we're going to range. And that could continue to range in an extended period of time. So for bulls who are, impatient, the impatience is not going to serve you well, right? If you are over leveraged in this market, if you're a bull that's over leveraged and price continues down further, you're at risk of going to the slaughterhouse. manage your risk and keep yourself out of the slaughterhouse. In terms of spot traders who may not be leveraged, and you're just looking to improve on your cost basis, or really just manage a longer term investment, I think the bottom lives in here someplace. I think the bottom is likely somewhere between, unless we see more evidence, right? But at the moment, based on what I'm seeing right now, seems like liquidity is stacked well in this 55K level. We could, of course, go a little lower towards the 50K level, but I think that that we're going to find this bottom somewhere in here soon, and hopefully soon. But if we don't get this breakout, we don't, we don't make it down to this range, then we're just going to keep chopping in here until something breaks, or until we have a catalyst, maybe the economy, maybe an economic marker. We do have some inflation data coming out next week that could trigger things. PPI will be watched very, very closely. That's probably the biggest thing. Then we have an inflation rate data report coming out on Wednesday. So next week's inflation reports, and of course, those jobless claims and housing reports. Jobless, we had a hot jobless report yesterday that had some correlation with the hot unemployment report the week before. So if we see those trends continuing, then that would be a reasonable expectation and a reasonable catalyst to get things moving. Look at this. We have a Fed chair speech on Tuesday too. So, man, Tuesday is going to be a big day. Regardless of what the report says, Fed Chair Powell is going to get the market moving one way or another. And I would say a good PPI would certainly be well received. So these are the things that we're watching as we head into the weekend. Resist the temptation to overtrade. Manage your risk. Do not go to the slaughterhouse, my friends. Definitely manage your risk and keep yourselves out of trouble so you can stay in this game for a long time. In the meantime, I'm going to be watching this, right? So the fact that we do have some of these bids moving up, right? Some of this liquidity moving up is good, and reasonable to think that we're going to get a bounce out of this without just boom flushing down below. So that's pretty much where my focus is for the weekend. Jonathan has another question. Could you talk about the thin liquidity block above 60K on the 1-day fire chart? Because how you said thin liquidity equals volatility. Yeah, sure. So above 60K, he's talking about this right here, right? Let me take it to the D chart. Great question, Jonathan. As liquidity gets cleared, and this, let me zoom out for a second. As liquidity gets cleared out in either direction, right? It creates a void, and it's easier to move through those thin areas of thin liquidity. If we say that liquidity dampens volatility, meaning it's difficult for price to move through heavy concentrations, heavy volumes of liquidity, and it's easier to move through this thin liquidity. It takes less money to move through thin liquidity. So in terms of what we're seeing here on the daily chart, you better believe it. This is very, very thin, okay, because it's just been cleared out. So if buying starts, and this isn't what you want to see, right? You see this block right here at 59K that just dropped down to 58.5. That's not a bullish sign. So I'd be much happier if this was moving above 60K in terms of bullish perspective. So yes, price can move through this much, much easier. What we're seeing often is icebergs that appear. Icebergs are orders. They're basically conditional limit orders that don't appear until price reaches a certain level, right? So we don't see anything here at this moment. As price goes up, we might see a block, boom, just suddenly appear. So those are the things that you have to watch for. You can see that the market is collectively dumping into this range. Red is starting to buy just a little bit. It's purple that I'm really watching for the most to see when they start buying with volume. But when they're in this thin zone right here, they really can't buy with volume because there would be too much slippage. So that's when we start seeing the smaller order classes like red and green start to buy incrementally because they can do so with less slippage. That doesn't mean, what you need to understand is, whales can disguise themselves as any smaller order class. The small order classes cannot disguise themselves as whales because they don't have the stack to do that. So yes, price can move through this very easily if we could get some volume. If we could get these guys to start buying, then we could see potentially price move up back up to the 63K range without a lot of friction. So that's what our eyes are on. And when you subscribe to the Fire Charts live chart, and I'm here on our version 2.0, which updates much faster, has real time, near real time pricing and CVD data. This will give you the edge that allows you to see when these moves are happening. Right? We could see when this block came in here that it was going to apply pressure and push things down, and we can see when selling begins and when and when buying begins. And right now we're waiting for some buying. All right. You can see now this block of liquidity here likely going to change here on us in the next on the next update. But look at this, a ladder now appearing of asks because some of these folks are in buy the dip, sell the rip mode. A lot of people day trading this volume. So, Jonathan, I appreciate the question and the follow. Both good, but good comments today. So, this might bring us back down. We might see maybe a push down to 60K or maybe even back down here. That's what you got to watch, and that's what you get out of the live chart. Hope that answers your questions. Hope you guys are getting something out of the content. If you are, do me a favor, please smash all the buttons, share a comment, and help me grow the channel. I appreciate the support you guys have been showing me, and I hope you're getting some value out of this. Of course, nothing I say or share should ever be considered trading advice. It's a risky game, guys. Do your own research, manage your risk, and stay in this game for the long haul. Whatever you do, stay out of the slaughterhouse. Have a great weekend, guys. We'll be in touch.